Hello viewers, welcome to my channel. I'm Hasham. So now I'm going to start a new topic in the subject cost control and management accounting. Already in this subject, I have completed the topics of marginal costing, decision analysis, standard costing, budgetary control, ratio analysis, cash flow analysis. These are the topics already I have covered. Now I'm going to start the next topic called financial statement analysis or techniques of financial statement analysis. So in this video, in this theory video, I'm going to explain you about the basic concept of the meaning of the term financial statements. Then what are the components of financial statements? Who are the parties interested in financial statements? What are the objectives of financial statements and limitations of financial statements? Then the meaning of the term financial statement analysis, significance or importance of financial statement analysis, and objectives of financial statement analysis. Lastly, techniques of financial statement analysis. These are the topics I'm going to explain you in detail. I already stressed to you in the previous videos that before start watching the problems, you must be completely acquainted with the concept. Without understanding the concept, you cannot understand the solution, the problems. That's why my suggestion to watch this video carefully till the end with full concentration. Then only you can enjoy the learning process of the problems. So before start explaining the topic of financial statements, take a screenshot of the notes which I have written on the board so that you can make a permanent note, permanent copy. And before examination, if you review, definitely you can get a good command in examination. Take a screenshot, then I'll explain. Come on. Now I'm going to explain you first of all about the meaning of the term financial statements. Analysis we'll discuss later. The topic is technique of financial statement analysis. But without understanding the meaning of the term financial statement, we should not study analysis of financial statements. Financial statements are the end product of accounting. Accounting will begin from writing the journal entries, recording the journal entries. That is the first step in accounting, and preparation of financial statements is the end product of accounting. That means the process of accounting consists of first recording the transactions in the books of original entry, that is subsidiary books. We record the transactions as and when the transaction takes place. Later on, the transactions will be posted from journal to ledger. This posting will be continued throughout the year. At the end of the year, all the accounts will be closed and balances will be calculated. By taking that balances, one statement is prepared called trial balance. So after making the trial balance, we will make the final accounts. The final accounts consist of profit and loss account and balance sheet, or income statement and position statement. So these income statement, position statement which we prepare at the end of the year are called financial statements. So here specifically I have written, it refers to a set of reports, schedules or notes. Any type of report, notes, schedules which are prepared by the accountant at the end of the period, at the end of the financial year. So financial statement are the end products of accounting, financial accounting, prepared by the accountant that reveal the financial position and the result of the operations. Every businessman, every owner, every manager wants to know what is the financial position at the end of the year and what is the operating result, whether the business has earned profit or incurred loss. So to find out the financial position, to find out the profit or loss, the final accounts are prepared. So these final accounts are called financial statements. Now financial statements are a historical document because whatever had happened past in the last 1 year, that will be recorded. That's why it is called historical. They show a summary of financial performance of an organization for a defined period of time and its financial position at the end of the period. So these financial statements will provide the summary of all financial transactions that took place during the financial year. So we'll take a summary. We'll take the total of all the transactions which had been conducted in the financial year. Next, components. So I have explained you about the meaning of the term financial statements. Financial statements are the end product of accounting. It consists of the reports, schedules, notes which are prepared by the accountant to find out the financial position, to find out the operating result during the period of time. Now, components. What are the components that are included in financial statements? According to Companies Act 2013, the following are some of the items that will be included in financial statements. But these items are inclusive type. We should not think that whatever specified by Companies Act, these itself are the financial statements. No. Apart from that, any other schedule, any other note, any other report will also become a part of financial statements. So what are the items that are specified by Companies Act? First one, balance sheet of the company at the end of the year. This is also referred to as position statement. The first item, which is a financial statement, is the balance sheet. The balance sheet will list down the assets and liabilities. It shows the financial position of the business at the end of the period, as on a particular date. In India, we call it as balance sheet, but internationally it is also called as position statement or statement of financial position. Secondly, a statement of profit or loss for the financial year. This is also referred to as income statement. First statement, balance sheet. Second statement, profit or loss. A statement which shows the profit or loss during the period of time. In India, we call it as profit and loss account. Internationally, it will be called as income statement. So first, balance sheet. Second, profit and loss account. First one, statement of financial position, and second one is income statement. Now third, a cash flow statement for the year. Nowadays, cash flow has also become a part of financial statement. It is very, very important apart from balance sheet and profit and loss account. So a statement showing the cash flow during the year. Next, a statement of changes in equity. A statement which shows the changes in equity. Equity consists of capital, reserves, surplus, etc. So how all these equity changing from one period of time to another period of time. Next one, all explanatory notes to any of the above. If any schedule or note is prepared on these items, on balance sheet, on profit and loss, or cash flow, or statement of equity, any schedule or note prepared, that is also a financial statement. So these are the items specified by Companies Act 2013. But apart from that, the board of directors will make a number of notes, schedules, or any other report. And all the reports which are prepared by board of directors, that are also financial statements. There is no limit to any number of how many items will come under financial statement, any type of report. So example, apart from above statement, the board of directors, BOD stands for board of directors, may prepare additional statements or reports and provide additional information to shareholders and other parties. See here, a number of parties are having a stake in the business. Every party has to take a financial decision. So these financial decisions will be taken on the basis of financial statements. So the purpose of making these financial statements is to provide the information to different parties. On the basis of this information, the number of parties will take the decisions. Now this may include director's report. What are the other things which comes under financial statements? Directors report, auditors report, segment-wise reporting, accounting policies, corporate governance report, or any other report or statement. So all these will come within the ambit of financial statements. Now all such report, statement, or information which help the user of financial statement to get a better understanding of the financial position of the organization can be considered as part of financial statement. So any type of report, any type of schedule which will help the decision maker to take the decision, that will be considered as financial statements. So I have explained you about the meaning of the term financial statement and the components of financial statements. Now, who are the parties who are interested in financial statements? Nowadays, a business organization has so many parties who are having a stake in the business. As the company grows, a number of parties are there who are having a stake in the business. So these parties are interested in financial statements. So who are the parties who are having a stake? First one, owners, investors, shareholders. The owners of the business wants to know, example, sole trader. The sole trader wants to know whether my business is earning profit or incurring loss. Similarly, if the business organization is a company will have so many of investors, shareholders. The investors and shareholders wants to know what is the financial position of the company. Suppose I am the investor, prospective investor. Presently I have not invested, but I am deciding, I am proposing, intending to make the investment in the company. So before making the investment, I want to see the financial position of the company. Only after analyzing the financial performance, I will decide to invest. So investors are the first person who are interested in the financial statements. Secondly, lenders. Nowadays, a business organization will borrow money from so many lenders. Example, bankers. Normally, every business will take a loan from bank, credit facility from the bank. So before extending the loan, the banker will find out what is the financial position of the business. The next one is employees. The employees are providing the services to the business. So employees are interested whether the company is performing better or not. Otherwise, they will switch over. They will leave the company. They will resign. If the company is prospering, then employees will ask for more hike in the salary, bonus, incentives. So they are interested in financial statements. Next one is creditors or suppliers. The suppliers or the creditors, before supplying the material, they want to see what is the performance of the company. If the company is good, they come forward to supply the goods. Next, customers. The customers are also interested in financial statements because they want the quality goods at a reasonable price. Next one is government. The government is also having an interest in the business because the government will collect the taxes, and taxes will be applied on income. Income will be shown by financial statements. The government is interested in the financial statements of the business to collect the taxes. Next one is public. The general public wants to find out what is the financial position of different companies. So the performance report, the position report will be supplied by the financial statements. Last one, analysts, the researchers. The researcher analysts want the complete data of different business organization. So these are some of the parties who are interested in financial statements. Next comes regarding objectives of financial statements. The three main objectives of financial statements are: first one, to provide information about financial position of the business. The financial position means how much the business owns and how much the business owes. So what are the assets and what are the liabilities? That is called financial position. So the objectives of financial statement is to provide the information regarding financial position. Secondly, to provide information about financial performance. When the business is conducting so many activities, it will result either in profit or loss. So every business organization wants to find out whether our business is incurring loss or earning the profit. So these financial statements will provide the information about the performance, financial performance. Last one, to provide information about the cash flow. See here, we are not interested only in the profit. Ultimately, we want to find out the cash flow. So during a financial year, the business will get the cash inflow, the business will pay the cash outflow. So there will be cash inflow, there will be cash outflow. So a business organization will be financially sound if it is having sufficient cash. So the cash flow statement will also be prepared in the financial statements. These are the three objectives of making financial statements. Next comes limitations of financial statements. There are many advantages of financial statements, but it will also suffer from some limitations. We don't have only advantages. Limitations. The first limitation, quantitative. The financial statements will be prepared only in monetary terms. That means if any non-monetary event is there, that non-monetary event will not be recorded in the financial statements. But sometimes the non-monetary event will be significant, is very significant for the business organization, but it will not be recorded because it is non-monetary. So only quantitative data will find place in financial statements. That's the first hurdle. Second one, historical. Whatever had happened in the past, that will be recorded in financial statements. The financial statement will not record anything about the future, only about the past. Historical data only will be recorded. Thirdly, opportunity cost. In this financial statements, only the cost which is already incurred will be recorded. The cost which would be recorded or which is expected or notional items will not be recorded. Next one, no standards. In financial statements, there are no standards with which we can be able to make the comparison. There is no planning. Whatever had happened, we are simply writing it down in the financial statements. So there are no standards. No idea of efficiency. By preparing financial statement, financial statement will not disclose how efficiently the business is utilizing the resources. Next one is no aid to decision making. For decision making, we require the information not only about the past, but also we need the information about future. But financial statements will not show anything about the future. It will show only about the past. Next, no classification of expenses. In this financial statement, we will not classify all the expenses into detail. Only aggregate items will be taken. Next one, not free from bias. There is a possibility, chances that bias may be applied in this. That means purely on personal ground, the accounts may be manipulated. When the accounts are manipulated, it is affected by bias. So these are some of the limitations of financial statements. So I have explained you about the meaning of the term financial statements. What are the components of financial statements? Then what are the who are the parties interested in financial statements? What are the objectives of financial statements and limitations? Now I am going to explain you about analysis of financial statements. After preparing the financial statements, the next step is to analyze, to interpret. So analysis and interpretation will be done only after making the financial statements. So what is this financial statement analysis? Analysis is a process. Remember, analysis is a process of critically examining the accounting information given in the financial statements. The financial statements will consist of financial information. So analyzing or critically examining the financial information given in the financial statements. That is called analysis. Now, individual items are studied and the relationship with other items are established. What we will do in financial statement analysis? We study the different items. Example, in the case of balance sheet, we will have different assets, we have different liabilities. These are all the individual items. In the income statement, profit and loss account, we will have sales, we will have purchases, we will have expenses. We will make the interrelationship between different figures. Interrelationship between different figures of the financial statements. And thus the analysis of financial statement is a process of evaluating the relationship. Ultimately, the analysis of financial statements means making the relationship between different items which are given in the financial statement. Example, in the trading profit and loss account, we will have gross profit and we will have sales. So these two are different items. Gross profit is there, sales is there. Now we try to make a relationship between gross profit and sales. We are making a relationship, and this making a relationship is analysis of financial statement. That is analysis of financial statement. So why we make relationship? To get more information. By making relationship, the information will be generated. Otherwise, if we do not make relationship, simply if we keep as it is, we will not get the sufficient information. Now, importance or significance. I have explained you analysis. Analysis means individually studying the individual items of the financial statements and making the relationship between different items of financial statements. Now, significance or importance. Why this financial statement analysis will be done? So the significance of financial statement lies not in their preparation and presentation, but in their analysis and interpretation. See here, ultimately we need the financial information. The financial information we can get not simply by making financial statements. If you only keep financial statements like profit and loss account, balance sheet, we will not get sufficient information. After making financial statement, if we make the relationship between different items and make the analysis and interpretation, then we can get more financial information. Thus, this involves a study of relationship among various factors. This shows the importance of analysis of financial statements. Next, objectives of financial statement analysis. Why this financial statement analysis will be done? First, assessment of past performance. Every business wants to find out how we have performed in the last year, in the financial year. At the end of the financial year, we want to find out what we have done, how much profit we have earned, how much loss we have incurred. The assessment of past performance is the objective of financial statement analysis. Second, assessment of current position. So current position and past performance evaluation can be done only with the help of analysis of financial statements. Assessment of earning capacity and future growth. By using the past performance, we can be able to make the forecast about the future. Normally what will happen? The past will repeat in the future. Whatever had happened, the same thing may be repeated. Whatever yesterday had been was there, presently today and tomorrow will be also the same day. Like this, we can be able to expect the earning capacity and future growth. Similarly, assessment of solvency. Whether the business is solvent or not, whether the business can survive financially, whether the business can survive or not, solvency can be ascertained. Prediction of bankruptcy or failure. The business will not collapse all of a sudden. Slowly the business will sink. So if we make analysis of financial statement, we can be able to know what are the failures, how the business is drowning. Next one, assessment of managerial efficiency. By making this financial statement, we can be able to evaluate the efficiency of the managers. Inter-firm comparison. Very big advantage of financial statement analysis is comparison. A business has to compare with other firms, and also a business has to compare with itself last year to current year. So comparison is possible only with the help of analyzing the financial statements. Last one is decision making. A number of decisions can be taken by different parties on the basis of analysis of financial statements. So these are the tips why financial statement analysis is required. Now, what are the methods or techniques of financial statement? Because the heading of the chapter is techniques of financial statement analysis. So, what are the techniques? Different techniques are there. The important techniques are: first one, comparative statement; second one, trend analysis; third, common size statement; fourth, funds flow analysis; fifth, cash flow analysis; sixth, ratio analysis. These are some of the techniques. It is not the exhaustive list. Apart from this, many more techniques may come. But the important techniques of analyzing the financial statements are these 6. So in the next video, I am going to explain about each technique. What is comparative statement, what is trend analysis, what is common size statement, what is funds flow, what is cash flow, what is ratio. All these things I am going to explain in the next video. So watch this theory video not once but twice, thrice. Then only you can be able to get the complete conceptual clarity. You can understand the problems better. Inshallah, we'll continue this theory lecture in the next video.